My laptop sounded like it was going to take off there in a moment. Do you ever get that? Like the fans just start heating up and you think that you bought a bloody jet engine instead of a laptop? Things about to fly out the bloody window. Good evening, everyone. Audio, video, let's do the normal checks first, and then we'll get straight into it. Yeah, I'm sorry the duck isn't here. Some changes of plans. You've got the B team instead in the form of me. But the good news is, next week, we'll most likely have Loomdart back to talk about shop. So that's something to look forward to. And the Gainsey episode, as always, is worth listening to as well. Also see Credible Cryptos join the chat. I think that's your first time I've seen you, mate. How's it going? The amount of times I've been mistaken to be this gentleman via private messages is really something. One of us needs to rebrand. I'm not doing it. That's a joke, obviously. Don't know why my laptop's choosing to expel so much heat. It's not really doing much, but here we are. As you can tell, still no internet at home. 3 weeks later, some really fantastic technological developments taking place. So they fixed the internet at home now, and everything works except the Ethernet through which I connect my desktop. Isn't that fantastic? So I'm still short of luck as ever, and waiting for that to be fixed, hopefully on Monday or something. I'm literally so desperate that I bought a 50-meter Ethernet cable, and I'm just going to plug it into the bloody Wi-Fi broadband hub thing downstairs and wire it up to my room. I don't give a shit. It's that bad. Hope everyone's doing well on this Friday. We've got some interesting things to talk about. We will start with some markets, but I want to do some edumacation stuff as well, purely out of guilt, you know, because I've had this entry triggers idea for the article. I've had it planned out in my phone notes for like weeks now, but as you can tell, I haven't gotten around to actually writing the article and making it. So in order to rid myself of some reasonable degree of guilt, we're going to talk about markets first, and then go over some of the entry trigger stuff that I think is useful. If that sounds good to you, you want to get going, make sure to hit the like button. And also, of course, as ever, thank you to Bybit for sponsoring Technical Roundup, the newsletter, as well as the YouTube channel. Their link is in the description below. Make sure to click on it so they don't ditch us. Jokes aside, they have been incredible, and as you can see, it's the content we want to make. No censorship, ref-link, aggressive, shilling nonsense. So, with that said, just seen the likes spike. Thank you very much. We're also at 10,500 subscribers. The support has been fantastic, and we are very grateful for it. And don't take it for granted. Hopefully you can continue enjoying the content, etc., etc. Let's get moving. Now, in terms of markets, the more detailed outlook will be given to you on Monday by myself as well. But for now, just to do a brief overview, there are signs of strength, given that this low volatility period has been broken to the upside, right? I think market structure is still to be debated amongst people who've got nothing better to do. But if we were in low volatility conditions and we've had a breakout, albeit coming into a weekend, I think that matters too much. Let's look at where we are structurally. And I think the two levels from the last live stream are as pertinent as ever. One is daily resistance in this 11k area, the bottom of the previous range, or if you don't want to anchor it all the way back here, one could be excused and quite simply just draw it off of the highest close here. So that's kind of immediate resistance where we are now. Now, in terms of structure and higher time frame reference points, you know that we've added some significance in the form of the 10.7 level. That's the quarterly support resistance level as well as the monthly open. So there's some good stuff going on there, or stuff that's worth keeping an eye on at the very least. And we were quite generous in our delineation of this area just by using the highest close and lowest close before this really short-term break in market structure here. Should have been resistance if the market was bearish or were to continue raging. It's now been broken, so I'm expecting dips back into this level should they occur, which isn't too unreasonable given we are at resistance. Something like this If the market's going to be bullish and put in a higher low, for me, it really needs to happen at or above the 10.7 level. So the structure would resolve something like this, with the pullback entry type of scenario occurring within the red box. As we'll come to discuss when we talk about entry triggers, it's never really that simple, but there is still a lot of value in A, delineating the levels we want to do business, and B, marking the direction in which we want to do business should a break or continuation occur at those levels. That's really the core of a trading plan. I know there are varying degrees of detail that people like when it comes to articulating trading plans, but I think for most discretionary traders, technical guys, whatever, a bare bones construct is better than none. And the two things that are really important are which areas matter, where do I want to do business, and in which direction do I want to do business at the level as well. I think once you've got those two, you're far better off than having nothing at all. And it's really the refinement, execution, etc., that really drives the rest, right? So that's kind of where Bitcoin is at right now for me, at resistance, but red box pullback should hold if the market's bullish. And should that occur into these prior lows, kind of where we are now, but more likely back into these 11K plus high time frame levels of resistance. The bearish case, of course, being falling back below 10.7. That would be a failed breakout above a monthly, quarterly, whatever level, and that would suck. It wouldn't be super bearish per se, I don't think. We'd probably just go back to ranging, and we will have poked the top side of the range, so I'd expect us to move closer towards the bottom side of the range if that occurs. But for now, again, on Monday, we'll dive into more detail, but looking fine at local resistance, but structurally developing positively, right? And we know where to look for a higher low if things continue going or developing in this manner. ETH, for me, the lower time frame price action is slightly less clear than on Bitcoin, right? The stuff that really matters for me is quite a bit above market and below market. This kind of area isn't my absolute favorite. We are at weekly support. That shouldn't be missed in the form of this lowest close. And we can see the last weekly close was on top of the level, and we're now kind of at the level as well, right? So nothing terribly exciting from the weekly, but the more important context is the kind of 380, 390 area. That's really the pivotal level for me. It's monthly resistance. Actually, let's just do it on the monthly time frame so it's clear, right? So for me, ETH closed bearishly on the monthly time frame, and the reason for that being, and by the way, the link to the newsletter is in the description. If you just want the kind of text hit and run version of it, really clean, straightforward bullet points with the levels and the interactive charts as well. Make sure to go subscribe to that. It comes out every Tuesday. It's free as well. But the long story short for ETH, and the reason for a bearish directional bias on a high time frame until proven otherwise, is because we have this fantastic level on ETH, no matter how you chop it. This monthly kind of first highest close, top of the range, all-time high breakout, support, and then the break of that level then led to our kind of downtrend before the bottom, resistance again, and then when we came back into the level, this price action at the level itself is something that's bearish to me, right? If we look at the last two closes that occurred at this level, you'll hopefully know from my videos, it's the kind of clean double close, bearish pattern, where you get a close above a level, which is bullish, yay, continuation, and then the next candle closes back below the level, which is normally suggestive of a kind of failed breakout. And the context is especially useful here because the failed breakout isn't just occurring in the middle of nowhere, right? We haven't just arbitrarily delineated or paid attention to a green candle and a red candle and saying, oh, look, that's bearish. It's not the sequence that really matters, it's the context, right? So we're at one of the best levels on the chart, monthly, weekly. It's just an area that is hard to ignore. And then the price action that occurred is you've got to close above the level, which should have been bullish, and offered the market every excuse to continue higher into, you know, the 700 handle, the top of the range, for example. Instead, what we had was a spike above previous month's high. So that's likely to have induced a fair amount of breakout / continuation traders or systems. And then the close occurred below the level itself. Yes, it would have been more bearish if we spiked the previous month's high and then closed below the low. That would have been really ugly. But for me, still technically, as well as kind of contextually, the fact that we spiked previous month's high and then closed below the high time frame level, kind of no matter how you delineate it, suggests a failed high time frame breakout in ETH USD, and that kind of informs my directional bias. So purely technically, I'd expect rallies back into the level to get sold, and the nearest high time frame support on the monthly, I think, is reasonably unambiguous in the form of the highest close at 300. Okay, and we can take a look at this area on the weekly time frame. It should just be labeled monthly. Here we go. That's the level, right? It's going to make it red. And that's what we had. When I mentioned it had every excuse to act as support and trade higher. You can see that on the weekly candlesticks, right? Closed above. We had support for a couple of weeks. And then look, where has the volatility, in which direction has the volatility or the large amount of trading or whatever terms you want to use really been in? It's this really bearish outside bar on the weekly time frame. As mentioned on the monthly, completely smashes the range with this wick high and then nukes below it on the close. And since then, this price action for me is certainly less informative than the big bearish candle, right? So that's ETH until proven otherwise. I think invalidation is pretty straightforward. If we get strength back above the cluster, top of the range, whatever, so anything strong through 380, 390, if that area fails to act as resistance, then we're back in business. But for now, given the failed monthly, weekly, every time frame essentially breakout at a key level, that's going to inform my high time frame bias. Beyond that, you be my guest. I think there's a good chance, looking at the price action developing now, that we retest this monthly level just from the monthly time frame, but also the intraday price action. And in a similar vein to Bitcoin, this last rally broke above some key levels, right? So for Bitcoin, we're back above the quarterly 10.7 level, so dips into that can reasonably be expected to act as support, or that's certainly something we can wait for. And for ETH, again, this breakout closed above some important levels, slightly less important than Bitcoin, but the intraday / weekly level, I mean, they're both confluent at the 350s. We can just draw a box, right? Price is currently above it, so in a similar vein, even if we get a bearish retest in the market, we could get something like this to take us there. Okay, but I think the key theme being Bitcoin is above high time frame resistance, which makes it more bullish, and its monthly close was above monthly resistance, whereas ETH closed below monthly resistance, and any rally continuation will take it into a bearish retest area as opposed to above it, right? Which is kind of the difference in Bitcoin and Ethereum at the moment, at least structurally, but that's not being reflected in ETH BTC at the moment, so God knows, right? We can talk about that all on Monday. We can see ETH BTC pretty much bouncing from, it's called resistance on the chart, but it's this prior level of support. Not a whole lot going on here, right? Just a whole lot of consolidation, ranging, all that good stuff. I really think that's it in terms of markets for stuff that I want to talk about, at least today. YFI was a good one. This isn't the chart. There's another one. I think the Bitcoin chart as well kind of looks the same as the dollar one. Yeah, how this is actually a good example of the technical structure I moan on about all the time on stream, where you get an impulse, a consolidation, and then continuation in the impulse. It's the consolidation itself forms a range, right? And that range is support and resistance, or a very valid technical structure in itself. And there's a really good example of that in YFI, and we wrote about this in Technical Roundup as well. Highest close, lowest close of the consolidation that immediately preceded the run up. Market pulls back, hits that level, and bounces. Great, right? In this case, it's not as clean on the BTC chart. I think the USD chart bounced at the bottom of the cluster. I could be wrong. That's probably worth checking. Is there an FTX? Yeah. So that's kind of what I mean. You see, the charts are very similar, but again, if we take the consolidation, essentially split it into a range where we get the highest close as resistance in the range and the lowest close as support in the range, that's kind of where the bounce occurred, right? Purely speculative technical stuff. When I see really quick bounces like these, where price hits a key level and immediately reacts and spends very little time there, it's likely that support gets retested. So I'm expecting this rally to get stuffed a little bit somewhere at resistance and to offer a retest of one or both of these range boundaries. And again, not to borrow too much from previous live streams, but that is a common misconception. Whenever I draw a box or some of this consolidation structure stuff, it creates the impression that the whole box is support, which it technically may be, but it's really the upper boundary and the lower boundary that I'm worried about and where I want to trade, right? What happens in the middle, you can argue, range, midpoint, whatever, not terribly significant in my view. I think the box is just a very useful way of looking at it, as long as you know that the boundaries are the areas to do business. Okay, and as I said, for YFI, I think this chart is pretty straightforward. There's this cluster, which is currently bouncing price at 12s and 15s, upper and lower boundary, and then this lowest close closer to, what is that, 22-ish, 22K as the broken support after the head and shoulders. So where does it make sense to be bullish? For me, at the bottom of the cluster, kind of the extreme, that's where you're closest in validation and have the best risk reward and, you know, do or die, all that type of fun stuff. The teeth gritting level is at 12,380. Or if you're more of a momentum continuation sort of person, a reclaim of broken support will probably take us towards the opposite side of the range, closer to 36s. So where it is right now, again, not interested. I'd want to do business within the red box again, or on some sort of range reclaim to prove to me that it wants to trade at least the top of the range, if not higher. Okay. Any questions so far? Does that sort of make sense? Mo says, where are articles? Coming soon, I guess. Do I think ETH is going to start outperforming Bitcoin again? It really depends. Purely looking at technicals, I think the evidence seems to suggest that Bitcoin, if anything is going to outperform, it's going to be Bitcoin, just based on high time frame closes and where it is relative to structure. But the market can change on a dime. If we get a kind of double bubble for DeFi, then one could argue that ETH might outperform. But again, anything that I take based on that will most likely have to be technical. And so ETH has a lot of catching up to do if that's the case. Are you guys still short on Link? I was never short Link. I think Duck closed some time ago, but I could be wrong. You can ask him. Yeah, so that's markets. If any of that was helpful, let's try to get to 100 likes. Wink, wink, nudge, nudge. But if that didn't convince you, I'm going to do my best in the next section about entry triggers, where hopefully we can elucidate some of the concepts that I talk about when it comes to planning trades and shooting the shit with you guys and girls about what might be reasonably expected in the coming session, right? So what you'll often see, both with Twitter charts and traders and crypto YouTube, which is particularly bad, but more often than not, you'll have some delineation of a key level, right? Something that matters. It could be a open, high, low, and close. Maybe it's some sort of footprint, a significant point in the market footprint, or I don't know, some cluster of moving averages, some sort of box, range, whatever, right? A key technical level. What you'll often see, especially if one doesn't have a bias heading into the market, let's say price is somewhere here, you'll see something to the effect of, well, if this happens, you long, and then if it comes in and does kind of this sort of thing, right, and breaks down, you short it. And that's the trading plan. Well, fantastic, right? Because if this model were to be correct, and if trading actually works this way, then it becomes very hard to lose money. Because if all you have to do in that case is correctly identify the level, right? And then once you've correctly identified the level, if it is significant, the market will do something at that level, and you expect some sort of turnaround, volatility, or activity either way, be it in the form of fresh buyers and for continuation, or sellers to step in to create a reversal. You're expecting it to be significant one way or another, right? Now, if level selection were the only thing that mattered, it'd be very hard to lose money. Because if the market were to go up and break this level, well, you kind of planned for it, right? So you had an opportunity to make money. And of course, we all know that squiggly lines equals trades. And the same here. If the market broke down, obviously you had a plan to break for it to short it. So therefore, if it happens, you also made money. Unfortunately, that's not how it works, right? Even most diagrams, which show very kind of clean, break the level, retest, pull back, and continuation, or kind of the break the level, pull back, then break market structure, right? And then offer continuation. All of these are rough depictions of things which never or very rarely look so clean when it comes to actually trading them. Perhaps more dangerously, in my experience, and I bet this is the case in yours as well, even if the market does and is generous enough to offer something so nice and so clean, where it does break the level and come back and beautifully retest it, etc., it's one thing to plan to take that trade when the market's not at the level, but it's another thing entirely to actually sit there, buy that retest when it looks scary, and pull the trigger on the idea when it's happening, right? It's a basic point that you can get your levels from Twitter, right? There are a lot of really good traders / analysts who will post their whole chart setup, all their levels, their plans to Twitter at the same time, and you can copy and paste their levels, but there's no guarantee you'll be able to actually trade them and or make money. So what does that suggest? In my view, it suggests that level identification is just a very, very small part of successful trading. It definitely isn't enough for a trading system, and it's really the execution at those levels, if that's something you use, or in those areas if you use other tools, which makes or breaks a trading system. Like, for example, how many times have you sold the same level that you planned to buy because of some other time frame price action? I've probably done it dozens or hundreds of times, right? Or how many times have you bought a level that you planned to sell because of some low time frame price action, or maybe even on the same time frame, some sort of candle close, or paid attention to something else, or quite simply abandoned your plan? Again, I've done that dozens, probably hundreds of times. And that's completely normal, and it just goes to speak to how not easy it is, and the great bridge and gap between actual charting, right, which is just sort of delineating areas in the market which may be interesting and speculating on possible direction, versus actual trade execution, which is completely different. So I suppose what I'm going to try to do here today, to some extent, and hopefully in article form sooner rather than later, is elaborate and give you some tools, specifically entry triggers, that will allow you to give more context to price when it's developing at areas that you feel are significant. Because something that certainly I pay a lot of heed to and plays a big part in my system, certainly in the last kind of 6 months, is that no two trade setups are the same. And certainly as discretionary traders, no matter how much we try to quantify and find analogs and really kind of nail down our bread and butter, the type of bread and the thickness of the butter is always going to be slightly different. And if you don't have a toolkit that lets you adjust to the nuances and essentially bring your technical idea to life, even if it doesn't look exactly perfect, then trading becomes a total pain in the ass. And it already is for many other reasons, so why make it more difficult than it has to be, right? That's kind of the intro, I guess, for entry triggers. As in the words of famous German philosopher Immanuel Kant, I believe he said, everyone has a plan until they get punched in the face, right? So that sort of applies to trading as well. You can look at a level and say, oh, mate, I'd fucking love to sell this level. It's such good resistance. And then when the market actually gets there, you sort of shit yourself and don't know what to do and essentially freeze up, right? So it happens on the other side of the market as well. Certainly in uptrends, right? When the market looks really bullish and it's printing absolute green candles and you've got a level delineated and you think, oh, please God, just, obviously while the market's here, please God, any small pullback, just give me a red candle. I swear I'll go all in, swear on my nan's life, right? And then obviously what happens is the market starts pulling back slightly and you completely shit yourself, start bear posting on Twitter, pull all your limit orders and look for any excuse to short under the sun. If you've never done that, or that's never affected you to any extent, I just don't believe you're being truthful. Because this still happens to me and still happens to experienced traders, just about recognizing that and having a system that caters for those situations. So are you kind of with me so far on what we're going to do, why that's important, blah, blah, blah? Knight says, shitposting aside, coming from poker, trade execution feels like the easiest part to me. I think it really depends on your background, as you kind of suggested. If you come from a strongly technical analysis type of background, where you learned how to chart first and you really value charting, etc., and you kind of chart coins in Discord and for Twitter for fun, then execution absolutely is the biggest difficulty in a lot of those, if that's your kind of background. But maybe for poker it's different. I know for me, because I used to do a bunch of fucking TA back in the day, just random live streams, tons of charts, and YouTube videos, Telegram live streams. To this day, I still sometimes struggle with executing on plans that I have in a very detailed fashion. So I think it is really a big thing. 4 more likes. I love you all forever. But let's get straight into it. So the way I'm going to structure this, and again, this isn't going to be perfect. It's not pre-prepared. And the examples aren't prepared either. I actually don't have any, so you'll have to bear with me. But I'm going to go over some reasonable entry triggers, or at least ways I think are worth being aware of to actually get into a trade once something that you think is significant starts to develop. And then if the feedback from you guys is good, then I will certainly make it a priority to make a more detailed version in article form. Okay, and hopefully get that out whenever. But for now, I just want to go through a bunch of different entry triggers to hopefully give you more tools in your arsenal to be able to employ should the market start resolving in a way where you think you have an edge. So let's get straight into Paint. That's when you know the gloves are off, and get talking. So, different types of entry triggers. Boom. And again, this list isn't exhaustive. I'll add to it, subtract from it, etc., etc. Like, bear with me. If you learn at least one thing throughout this whole thing, it's kind of pays for itself already. Like the video, blah, blah, blah. So let's just draw a line. That's not down the middle at all, is it? Roughly down the middle. There we go. Okay. Yeah, that's still pretty terrible. We're off to a great start. That's kind of better. Whatever. Here we are. Okay. So what are we delineating or distinguishing between? So we're going to do entries at structure. Okay. So this is trading at those levels or structures themselves. And then entries beyond structure, which is something that's also very important. Now, the second one is something that's worth getting comfortable with. And I say this from a bunch of painstaking experience. If you constantly / only want to do business at your exact level on a super clean break, retest, spend 10 hours there, give you a fantastic candlestick confirmation, and then move away with 0 drawdown, you're kind of living in fairy tale land, right? Or at the very least, you're going to miss out on a shit ton of entries where you knew exactly, or you kind of had a very clear idea of what was going to happen, and as a result of what, but because you don't get the retest in a fast-moving market, that you end up not being able to give action to your trade idea, right? Now, again, it looks great on Twitter, like, oh, I called for a break of this level and it broke and the market went up. But what value is that if you're unable to turn that into a setup? Again, it should be fairly self-evident that identifying levels and turning points in the market in itself is absolutely no edge or is minimal use. Everyone can do that, or anyone can do that for you, even if you can't do it itself. But clearly that is not enough for good trading. So at a certain point, I think it's worth exploring entries beyond structure because quite simply those level breaks, or when the market really powers through an area, you still want to be able to trade without that mega clean, slow moving retest pattern. And I know I've been on the wrong side of that a lot, whereby I said, as soon as this goes, the whole market's going to roll over, or the sky is the limit. Is that English? The sky is the limit? I think so. Anyway, there's scenarios where you just got like one line, and if it breaks, you're like, oh, it's going to be so bullish. And then the market just literally teleports through the level with like a big fat candle, right? Like this is your level. You're like, oh, it's so important. And then it closes here, right? Let's say it closes here. And you're like, yeah, so technically I'm really bullish because the level's broken. So like, do I buy a retest? And then the next thing that happens, you get like a smaller candle or whatever, and then just completely blows you out and you feel terrible because your idea was technically valid at the close here, but you didn't trade it at all because price didn't pull back to the level. So I think it's my personal view from my personal experience that can you get away with building an entire trading system by trading at structure? Absolutely. Do I still think, certainly in crypto or high volatility markets, that you're leaving something on the table if you have 0 entries that can occur beyond structure? I do think you're leaving something on the table, which is why we're going to try to cater to that or fix that to some extent. So let me get my phone out and turn off all this kind of stuff. I've got it in my notes as always. This is what I do when I'm on the train back to London or doing whatever. I just open up notes and try to come up with articles and content ideas, which mostly just stay on my phone and never see the light of day. So entries at structure, going in no particular order whatsoever. Number 1, and again, the names are sort of made up completely, but hit first oops, typing is hard. Hit first, think later, limit order. Okay, this is probably the most sort of trader education, bread and butter type of setup. And the basic example would be if you have a level that you believe is important, or you have conviction in, or you believe is going to be some turning point in the market. Let's take an instance of a support resistance flip, right? Market comes into the level, it's proven itself as resistance, etc. Then the level breaks, and as soon as it closes above the level, this event for you, right, the close above the level, this for you is technically significant. And in most trading systems that I'm aware of, or at least from the discretionary price action, etc. point of view, it's the close above the resistance, which then confirms, because confirmation is very, very much not a useful term in trading. It really doesn't exist unless your trader has Z, in which case it does, but the exception doesn't make the rule. Confirmation doesn't really make much sense in trading. But purely in terms of conceptualizing a trading system, if this red box was resistance, it's under most price action based systems, and again, I'm generalizing, there are exceptions to everything, but under most systems, it's the close or the clean close above the level, which then solidifies its status or forms its status as support, right? So at that point, when you get the close above the level here, the idea, right? What is the trade idea that we're trying to give life to? It's in which direction long, and where? Well, we're trading at structure, so it'll be at the level itself. So what's the entry trigger in those cases? Hit first, think later, right? Limit order. So at that point, you would have buys, orders to buy at the structure itself, meaning that if the market is to dip into it, then you would get filled before, presumably, if your idea is correct, some instance of continuation higher. Okay? Now, I'm not going to get to do a full pros and cons analysis, but purely on its face, I think in terms of pros, it definitely makes you more patient, right? You're not FOMOing in anywhere, and you're actually doing business at a predetermined level, which has kind of proven itself. So that's a good one. Less left to your discretionary decision making. Secondly, you tend to be closer to invalidation if you're trading at the level itself, because if you're expecting a bounce here and it doesn't bounce here, well, then the idea is wrong. And if you do business and execute trades close to where your idea is invalidated, that often results in superior risk to reward, because you end up in these sort of do or die, now or never scenarios. For example, let's take the same idea that this is resistance and the candle close has broken the level. Technically, to give, you know, if you wanted to give a form or actually take the trade idea then and there, what's wrong with just market buying this close? Because the close is what proved that resistance has been broken. So that's technically bullish. So you could buy there, right? That's one of the setups we will cover. However, if you do business at the level itself, you then don't have to potentially deal with the whole way of drawdown as the market pulls back into structure, right? And as you can kind of start to tell on the con side of, and obviously limit orders, most exchanges will either take fewer, you know, you pay less fees for providing or making a market as opposed to taking, right? With limit orders, you might even get a rebate depending on where you trade, etc., etc. But on the con side of things, it's really hard a lot of the time to predefine your risk on limit order trades. That's the first thing. It might simply be the case that there is no clear structure for you to put a stop loss. So you just get filled and then you don't know where to get the hell out. So that's a potential tough one. And then, of course, the second one is if something happens up here, which changes the context, right? Let's say the market breaks this and you get some really bearish news, for example, or something fundamentally changes your view on the market and you're asleep and you had limit orders left overnight, you could potentially get put into a trade by virtue of your limit orders that you didn't really want to be in the first place, given the new change in circumstances. Okay? Again, this is mostly off the top of my head, so if the feedback's good, I'll make an article, blah, blah, blah. But long story short, one entry trigger at structure that you can take. Certainly if you're someone who struggles with patience or FOMOs in a lot or just chases trades and does business kind of in the middle of nowhere, if any of those or more apply to you, the kind of hit first, think later limit order thing will tick a lot of the boxes that wouldn't otherwise be ticked. Okay? And the basic logic, as I said, you've got a level. Once it's broken, that suggests that it's going to turn from resistance to support or from support to resistance. And the trade that leads to is anticipating the flip should the market come back to the level, fill you, and then in fairy tale land, it just flies away and you make a ton of money. Okay, and we discussed some of the pros and cons there. Number 2. One of the more ambiguous ones, but still kind of hard to ignore. And this has loads of forms. I could certainly do 2.1, 2.2, etc. There are a million ways of doing this. Oh, my phone's going to run out of battery. Fantastic. Candle close. Fuck off. Candle close. So what's the basic idea here? Using our similar diagram of support and resistance, let's say you've got a level of resistance. Here, we can even, just for diagram's sake, say that it was prior support, right? You've got a big bounce, it's significant, the level's broken, and then it comes back, right? And it's retesting the level. A candle close entry, which takes many forms, certainly in this case, a valid trigger for this type of setup among money would be a test and a close below the level, right? So this is a kind of more of a wait and see approach, because with limit orders, you're not really waiting and seeing. You've got orders in the market. That's where you want to do business. Candle close is where you wait for more evidence to develop that resistance and sellers exist at the level. So let's say you get a candle which sort of tests the level and then closes bearishly. So you get kind of a wick through it, right? Something like this. And then the close, let's say this is a red candle, which it is. One version of this, or the most basic version of this, would be that after the test of the level and a subsequent close below it, it's the close below which is reasonable evidence that the level is resistance, and the entry is triggered on the close of the candle, right? And again, this is where you can pepper in all your amazing candlestick cheat sheet reversal bullshit, which rarely works without the appropriate context, but certainly it's under this pretext that a lot of that stuff comes together / potentially starts to make sense. Now, what's the issue, or what are some of the problems, or the pros and cons of a candle close type of entry? Well, on the pro side of things is that you are less likely to end up getting involved in a level which completely eats shit, right? So with a limit order strategy at the same level, right? Let's say when the market closed below this prior support 10 resistance, this is the close, and you think, right, well, my idea is it's going to flip from broken support to resistance and trade lower. So I'm going to go for trade entry number 1 and set a limit order to sell at this level. And instead, and again, I bet you've been on the wrong side of this, the market comes into the level, right, approaches your limit order, and then the next candle looks like the great-grandson of Chadicus Maximus Regimus III, and literally does something like that. And you feel like an absolute idiot, even though arguably you shouldn't, and you curse yourself for not saying, oh, I should have waited for confirmation, which is a really stupid thing to tell yourself in most cases, but whatever. I suppose one of the pros of a candle close system is that your chances of being completely blown out by a level eating shit are somewhat lower. I say somewhat because the candle close itself, especially if you ask Donald, he really thinks there's been some alpha erosion or edge erosion in the candle close system, given how popular it's been. But generally, I think on the balance of probabilities, it's fair to say you're less likely to get completely engulfed at a level than by just setting limit orders. Now, the second pro that just came to mind before I get into the cons is that when it comes to candle closes, it's reasonably unambiguous for the most part, right? You can literally hover over the candlestick and get open, high, low, close data. So the amount of, certainly if you want to backtest stuff or be more on the mechanical side of strategies, the room for error when it comes to a valid entry trigger / signal, if you're using candle closes, is quite low if you program appropriately, right? It either closed below the level, at the level, or not, right? And I say at the level / below is one thing, like a close which tests the level and then kind of closes on top of it, for me is still a close at resistance. It doesn't need to be like, okay, it tested the level and then it closed like this, right? Okay, that's a bearish close, now I short. I think that's stupid. But the basic idea still stands that for the most part, candle closes are less ambiguous than some of the other entry triggers that we're going to talk about. Now, what are the cons of using a candle close system? Well, one of them we sort of mentioned is that there's no guarantee that just because a price closed below a level means that it's somehow 100% going to hold or work. A lot of the time, you'll get a market that pushes into a level, right? It slows down and might give you a bearish close and a slight pullback. So then you enter on the close of that, and then it just goes on to break the level anyway. Again, I bet that's happened to you. So there are no 100% systems, right? All the entry triggers we're going to talk about, you're essentially making a balance. Well, it's a balancing act between how good do I want my entry to be versus what amount of evidence do I have that my idea is right, or that the trade is going to develop in my way. And then you throw into that the idea of trading close to invalidation, risk reward, blah, blah, blah. You get some really complicated shit, right? Another pro, or con, sorry, of the candle close system is that if you're trading on lower time frames, you can really kind of miss the move a lot of the time, right? So for example, market comes into the level, it hits it, you're thinking, okay, well, I'm going to wait for the close and then short it. And instead what happens is the market just completely fucking flies away and closes like down here. At that point, in terms of risk reward, let's say conservatively, your invalidation is like at this high or somewhere here at this high, if there were one, or whatever reference point ATR you've got there. By no means is it reasonable in most cases to take an entry here, given you've likely got some support not too far from market, or it's basically already reached its target. That happens a lot on candle close systems. You wait too long at a level, you're comfortable waiting for confirmation, and the price you pay for that is essentially missing the move. Is that the worst price to pay? Absolutely not. But as we'll discuss with some of the other entry triggers, a lot of the time it is worth sacrificing that kind of confidence or confirmation for a good / better entry. So one of the pros of a candle close system, one of the cons of a candle close system is that a lot of the time, by the time the candle closes, the trade is either over, or the risk reward that it ends up offering when the trade actually triggers is just so suboptimal that the trade idea becomes inactionable. Okay? Now, another con about the candle close system is that, and again, this is time frame contingent, but often you end up putting yourself into a very shitty entry just before the market turns around and offers you a better one, right? A really good example, and again, I'm sure you will have seen this a lot. I keep saying that, but it applies to just about everything. So let's say, same example, broken support turn to resistance. Market rallies into the level, okay, and you're waiting for the candle close, and then you get something which looks like this, right? So quite an unambiguous close, a fair bit away from the level, right? Certainly proves that there is some selling interest there. It closes away from the level, so then you end up market selling the close of the candle. I think there's another potential, like a mini con, that so many systems are now candle close oriented that if you're really strict with market orders at the open / close of these big time frames, so many automated strategies do absolutely the same fucking thing that you might incur some slippage or just a shitty entry because so much business is being done at the same level in the same direction, presumably, right? That's like a small thing up to debate, no strong views. But as to the con I'm actually talking about, you'll get the close below the level, which is still good enough in terms of risk reward. So that's where you get involved, and then what the market will actually do is come back, pull back all the way to the initial level where you wanted to do business, or where your trade idea is based, and then potentially even stop you out, right? Often it will actually push above the bearish candle or the thrust candle, like give a 3 drives or a final spike before then nuking and taking it lower. So in this case, the same con about risk-defined trade entry triggers also applies, but also here, potentially just waiting a little bit longer may have put you in a far advantageous position than essentially FOMOing the close of the level, right? So another potential con to be aware of. Let me see if I've got any other quick notes on candle closes. Yeah, another big thing is actually time frames. Holy shit, that's probably one of the hardest ones when you're dealing with candle closes. People just fuck up time frames all the time when it comes to these things. So the most frequent example, or the biggest culprit, will be trading low time frame candle closes at high time frame levels. Oh my god, that is probably the best way to just eat shit trading and completely flip your bias at just about every juncture. Is if your system doesn't cater for the difference in time frames and essentially filtering signal from noise when it comes to low time frame candle closes at high time frame levels. Okay, if this is like a weekly level we're dealing with, right? Oh dear. Let's say this is a weekly level, right? And you are looking at the hourly chart You'll appreciate I'm doing this with just about straight lines because touchpad reasons, so forgive me. So an hourly chart at a weekly level, like at a weekly level, price can reasonably spend like a week, potentially 2 weeks, or at the very least days before giving any sort of move, and likely before even retesting the level again. So if you're trading a strict kind of first test, best test, candle close system, and your system doesn't have a clear way, or at least a reasonably prescriptive way to deal with timeframes, then the amount you're going to get chopped at high timeframe levels, just with the low timeframe noise that's going on, you'll just eat shit, frankly. So that's another con of candle closes. As you can see from just the pros and the cons, it ends up being quite contextual. Like, how fast is the market moving? How much am I willing to sacrifice in terms of guaranteeing an entry versus trading at the structure? How do I reassess risk reward if the price is closing significantly below the level? Like, is that still the same trade? And adding to those confounding factors is the idea of timeframes, that if you simply do not have a system which allows you to navigate them somewhat smoothly or provide context as to whether those low timeframe closes are actually significant, then trust me, you will actually, don't trust me, forget that. I have good reason to believe, and I know from experience, that just getting chopped up by reading too much into it, especially if you're itching to trade at a level, is just not a great outcome, but also a very likely one if your system isn't nuanced enough to cater for those scenarios. Okay, that's candle closes to a large extent. We covered some of the pros and cons there. Before I go on to talk about overthrow / risk defined entry, is this interesting at all? Does that make sense? Do you kind of see? Do you want me to continue? Just any feedback would be fantastic. Okay, seems reasonable. Let's continue. This might be a bit of a long live stream, but it'll be replayable, so that's great. Trader Z in the chat as well. Good to see you, mate. Let's continue. Let's continue. And as you can sort of start to see, most of these have their own trade-offs, like the trade-off of confirmation versus a good entry versus how much heat are you really going to stomach on the trade, and all these sorts of things. And experience is really the biggest one that will, and actually live trading experience, testing, all that fun stuff. Let's get back into it. I still can't draw a line down the middle. Let me just sit back. Hold on. Okay, that's slightly better, I think. So where were we? Entries at structure. Entries away from structure. Right. So here we had one hit first, limit order, pros, no FOMO, close to invalidation. I mean, rebates. Anything else? Whatever, they're planned, whatever, that's fine. Oh. Hard not to execute. Unless you pull your order, in which case that's a whole different trading problem. Cons. I mean, this applies to all of them, but perhaps limit order more so. Could eat shit immediately. May get filled in a trade you don't want due to a change in circumstances, right? Blah, circumstances. English is so hard. Change in circumstances. What are this? And also defining risk. Oh, come on, give me a break. Defining risk isn't always straightforward. Okay, number 2. Candle close. Pros. Reasonably unambiguous. Is that how you spell that? Unambiguous? I think so. Reasonably unambiguous. Less likely to get steamrolled. I mean, some confirmation we've kind of talked about. Reasonably ambiguous. That's likely to get steamrolled. What are some of the other pros we talked about? I think that's it, really. Yeah. Cons. I mean, you could still get steamrolled, but the big cons are could be too late, trade played out, or risk reward no longer actionable, right? Waiting may provide superior entry. And there are some of the others we talked about, but again, you've got the benefit of replaying this, so go listen to those sections or wait for the article. But I think we've got most of the big blocks. Okay. Number 3, overthrow / risk defined entry. Ooh, this is where it gets fun, right? I guess another con is using a market order, but look, I'm not gonna. Let's just focus on the big ones, right? The ones that actually distinguish these entries from each other, as opposed to every little thing that could potentially be a pro or a con, which we can disagree on as well. So what do I mean by overthrow, risk defined entry? Let's take an example. So let's use another, in this case, resistance being broken and presumed to act as support, right? Well, actually, let's just use a dip into support as an example. Let's do that. So here's our support level, right? And the market is flying into this level, which you really want to be a buyer of. But you're not sure, or at the very least, you find that you don't want to eat shit immediately, like on a limit order, you don't want to get steamrolled at the level. And you also don't want to wait for the candle close, because maybe there's nowhere clear to put a stop loss at the level. So in this case, and again, I've got a full YouTube video on this called Overthrow for Stop Loss Placement. So go to my channel, Crypto Cred, whatever, go watch that. Also, very quickly, if you've learned anything so far, leave a like on the video, and that will be kind of what I use to measure whether to make the article. But long story short, overthrow / risk defined entry, what are we actually doing? We are waiting for price to give significant developments at the level before taking an entry. Specifically, candle close is usually just like 1 or 2 candles, right? The candle which tests the level, and then either that same candle closing below it or the next one. With overthrow / risk defined entry, this is one of the more patient ones where we're really waiting for evidence of someone eating shit at the level, and then we enter as late as possible to kind of step on their necks as those traders are underwater, right? So let's take this as a level of support. Just going to draw it like this, right? So a good example would be the market coming into this level, offering a little bounce at first, right? Giving some hope, then nuking the level, closing below it very bearishly. This signal in itself, you can see how these concepts overlap. This close in itself would get a lot of these guys bearish, right? But then what happens for an overthrow type of setup is that when price rallies to bearishly retest the level, it instead closes back above it, right? And you get a really clean kind of bullish spring, whatever. A lot of the time it's good if it makes a higher high at this point as well. Then we get into like fucking Quasimodo territory bullshit. But something like this, it springs at the level, and at that point, you're kind of buying pullbacks into the high or into the retest of the level itself. I suppose the super easy version of that would just be you have support, right? Bounce, close below, close back above, bounce, go higher. Now, in both cases, right, the top one's a bit more realistic, but the bottom one's probably one you recognize, over, under, Quasimodo, UB pattern, for those of you who remember that amazing time. The key thing to understand, in my view, in this context, is the significant event is what happens down here, right, at the low, and then what happens, so below the level, and then what happens above the level. There's 2 extremes that really matter. So what we're doing with an overthrow / risk defined entry is we're waiting for the market to define risk for us. So if we get this sort of pattern, closes below, then breaks above, and then pulls back to the level, okay? Those of you who've watched any of these videos know these type of patterns usually as resistance. You've got support, you've got the failed or attempted breakdown at support, and then closing back above it or getting back above it is bullish. So the level is once again support. So does the level matter? Yes, absolutely. But more importantly, the fact that we've had this failed effort to break it, which has then been squeezed up and pulling back, this price action at the extreme right, before the reclaim event, that is our kind of deviation or the extreme of the failed breakdown or the lowest low made, highest high made. Again, I've got a full video on this where I explain it in a much more regimented manner. But that low slash that high is what we use to define our risk, right? So in this case, the bullish example would be something like this, right? The market turning away. And unsurprisingly, the bearish example, and then X marks the spot in terms of where your risk is defined here. And then the bearish example is basically the opposite of that. Breakout, failed, pulls back into the level, right? At that point, you've got resistance, and where is the deviation, failed breakout attempt, highest high made? It's here. Okay, so with an overthrow slash risk defined entry, there is some degree of ambiguity because there's a lot of crossover. Like, where do you actually enter once that happens? Well, there are a few different scenarios. So if I really wanted to, I'd do like 3.1, 3.2. Maybe I'll do that. Fuck it, I guess we'll do it. Shit, okay. This is where there's some crossover. Okay. 3.1. Close back above the level. Market. 3.2. Retest of the level. Post deviation. Limit. Is there anything else I use? Close back above the level market. Retest. I think that's it. I can't think of anything else. There might be some dodgy contextual one. Oh god, yeah, there is. Retest slash break of the pre-breakdown slash breakout range. Market or limit. Fucking hell. I mean, this is kind of where I do most of my business. That's kind of the one which is going to have the most depth. But we can talk about it. Let me actually turn the AC on. It's getting bloody hot in here. I think it's this laptop. 1 second, gents. For you, mate. All right. Okay, let's go over those. I guess we're really in it for the long haul. Strap down, right? It's already 4 minutes until the stream technically ends. We're barely started. So let's look at the bullish example for all of these. So again, when do you start considering 0.3? When does it actually start to matter? It's once you get the lowest low formed at support, highest high formed at resistance, but then most importantly, the level itself, which is the basis for the trade, gets reclaimed, right? So in this case, it's not this. Ooh, no, that is the wrong color. Hold on. Whatever. So it's not the first bounce where you start considering the setup, right? It's not the break of the level where you get your entry trigger. You could potentially start considering the setup. That's a whole different directional bias thing, right? But most importantly, it's when price fails the bearish retest and closes back above the original level, thus reclaiming it, right? Support, failed breakdown, close above is the reclaim of this level. This close here, right? The close back above the level is where the whole of 0.3 comes into play. Okay, so what are some of the entry triggers that we can reasonably consider at, I'm going to make this in red, this point here? Okay, so number one is close back above the level in the form of a market order, right? That one's fairly straightforward. Failed breakout attempt, big candle, or, you know, real evidence of a spring, jumpy, bullish, Wyckoff, whatever bullshit you like. That in itself is bullish enough to warrant, at times, a market entry. So that's a potential entry trigger when you get this sort of price pattern. Closes back above the, got below it, back above it. You get the candle close on the relevant time frame, ideally the one which this level comes from. So hourly level, hourly close, daily level, daily close. Not always that easy, but as a rough guideline, that works. As soon as you get the market entry back above, post deviation, right? Not back above here, back above post deviation. That's when the market entry is one potential tool to use, right? Certainly if you think the market's springy or there's a sense of urgency, there are a ton of licks here, or you think there's going to be a big squeeze, OI, delta, CVD, RSI, divergence, whatever contextual bullshit you prefer. If there's a sense of urgency in the setup, that's where I think market order is most fitting. Pros and cons of the market order, pretty much the same as candle close, right? So again, reasonably unambiguous, that's likely to get steamrolled. In this case, just very unlikely to get steamrolled. In terms of the cons, again, the best place to do business is really at the level itself or close to the low, although that's risky and something I want to debate. Because yes, closest to invalidation is anywhere between the level and invalidation, but the trade is only valid if the level is reclaimed. So for me, it's still at the level where business should be done. That's a bit of a side rant. Anyway, close back over the level, market, fantastic. Pros and cons, as discussed, you're guaranteed a fill, and the trade setup is, you know, you're going to get a trade on. The cons, it could just come back to retest the level, and so if the close is just too far away, close all the way up here, all the way up here, the risk reward could be shitty, or you might have to stomach eating shit all the way until the market retests the level before trading higher. Okay, for the retest of the post deviation of the level post deviation limit, it's basically the same stuff flipped. You get the better entry, but you lose the guarantee of actually getting a trade, and it could be the case you get a close above the level. You know, you put your limit order in the market for your bread and butter textbook trade, and instead the market just teleports higher and you feel like an utter mug. Because again, going backwards, one of the first things we talked about, where is this idea technically valid? Is it here? No. Is it here? No. Is it here? No. It's on the close back above the level here that the idea is actually valid. And then it's a question of trade-offs. How much do you want to guarantee a trade at the expense of some risk reward versus optimize risk reward at the risk of not getting a trade if the market just starts to fly away? Okay, the last one, which is retest / break of the pre-breakdown, pre-breakout range market or limit. Watch the last, watch Monday's session for that. That's literally all we talked about on Monday's session. I think there's an example on Bitcoin of that. So again, of the pre-breakdown / pre-breakout range. Oh, fuck. I just lost all my notes. Shit, that was such a bad idea. God fucking damn it. Anyway, I'm totally not upset. Here's a good example of that in Bitcoin. It's kind of stuck in my head. This isn't the best example, but it kind of gets the point across. So look at this trend line. Where does it come from? Good question, actually. I think this is one of those high time for, yeah. So this trend line here, okay? I know some of you may be absolutely shocked, but I mean, when they're clean, if people are trading them, there's always a setup, right? This trend line here. 15-minute time frame. So the bullet point we're talking about is getting on a retest of the pre-breakdown or the, pre-breakdown / pre-breakout range, okay? So first thing we do, looking at market structure, where did the actual breakdown take place? Because again, if we're looking for buy setups, we want the aggressive sellers to eat shit. If we're looking for sell setups, we want the aggressive buyers to eat shit. And as they get the bigger spoon and, you know, get bigger mouthfuls, that's where we want to get involved as the market essentially exerts pressure on them by moving away from their entry, right? So moving from their entry higher, their break even, they start to puke, smarter traders pile on, blah, 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 all that shit. But in terms of structure, and again, this isn't the best example, go look at last live stream, but where did the break in market, where did we get the pre-breakdown range? So this is the breakdown, right? Both below the level, the trend line, but also in terms of market structure, right? You've kind of got equal / higher lows, and then quite unambiguously, that was violated here. So when we see those shifts in market structure, we like to look at what occurred immediately before that. And normally, and again, is it a breaker? Is it a little range? Is it support resistance? Is it an order block? Is it an engulfed supply zone? Is it all the same fucking thing? I think the answer to the last one is more obvious than all the other ones. But in this instance, for example, lowest close, highest close is how I like to do it. This consolidation, this mini range would be on the M5 or the M1, immediately preceded the breakdown, right? That's in range terms, in order block terms. This is like the up candle before the move down. You can see it's all the same shit, right? It's really context that matters. In the great words of Trader SC, context over pattern, I think he says, something like that. This structure occurred before the break-in market structure, okay? Then it should have been resistance, but we closed above it. So, just like in our diagram, you have the level, the deviation, the close back above the level. So at that point, in terms of our entry options, we could take a market entry on the close back above the structure. In this case, arguably this candle, most clearly probably this one, and your risk defined at the low. Or with a limit order, really anywhere within the red box in this case, or at structure itself, and your risk is defined by the same low. Again, the main benefit of the setup is that the risk is defined for you. There's no real ambiguity in stop loss placement. Because if the setup is correct, there's no reason why the extreme low or the extreme high should be getting retested. That's why I really like these setups. It takes that portion of thinking out of the trade. Okay? I think there's another example in ETH on lower time frames. I think so. Is there? This isn't great. Hold on. I remember seeing something on ETH. I don't know where it was exactly. Could it be here? Yes. Yes, it is. Yes, it is. This one is really reaching and hindsighty bullshit, but I kind of see this stuff on lower time frames. A lot of the time I don't end up trading it, but again, this is the far imperfect version of teaching all this crap. Let's take this consolidation, right? You could even delineate a level of support within the consolidation. Here, this is our M15 support. Agreed? And you can see market structure is broadly intact by definition because we're in the range. So things, shit's moving sideways, kind of equal highs and equal lows. Now, where is the break in structure? Or, you know, the real shift in balance, if you want to use, what is it, auction, market theory stuff, whatever, it doesn't really matter. It's kind of all the same stuff with some exceptions. Here, right? This break, close below the level. As we discussed, a lot of the candlestick guys, the candle close entry trigger guys, that'll be bearish for them. So we like to work backwards. Where is the immediate price structure, or the consolidation, or whatever you want to call it, that preceded the break in structure? For me, lowest close, highest close before the leg down. Okay, I'm going to make that in blue. And this works on kind of any time frame, really. I've just happened to be looking at lower time frames as examples are fresh in my mind. If I get enough feedback on this video, all the articles will have good examples, right? Anyway, here. So again, context. We've had a break in structure, and technically, this should be resistance now, right? Instead, you get strength through the level, and at this point, these sellers are sweaty and getting their spoons ready. Okay? So in terms of entry triggers, you know that if this market's going to be bullish and if it's going to reverse, there is no reason for it to fail or to get back below this level of support that we delineated at first. They make that in red. Red is the support structure, and the box is the kind of pre-breakout, pre-breakdown entry trigger structure that we're using. Right? Here. So putting these two things together, the break of this level should have been bearish. We get technical significance / our technical structure for entry from the pre-breakdown if bullish setup, or pre-breakout if bearish setup. Range, structure, candle, supply zone, doesn't fucking matter, same thing. Okay? So this should have been bearish. Instead, you get a close back above our entry structure. So at that point, our risk either way for the trade, no matter where we take it, limit, market, doesn't fucking matter, is defined by the lowest low made. And for entry criteria, ideally, at the level itself, more often than not, or to guarantee entry to some extent, at the pre-breakdown / pre-breakout structure, either with a market or with the limit order as well. Okay? Let me see. I feel like I'm missing out on like a really good example somewhere. Go back and watch Monday's live stream. It's literally all we did. All we did for that session. Let me open my notes. Yeah, so long story short, with the overthrow / risk defined entry, the pros Here we are. I'm just going to have to kind of go fresh, right? So for the risk-defined stuff... What the fuck? Oh. Pros. Stop defined for you. Setups have fuel. That's a really big one, right? There's always someone on the wrong side of risk-defined setups. Someone who bought the top, like, you know, bought the breakout or sold the breakdown and is now feeling heat. Though they act as fuel for these setups to move quite quickly. So that's some good technical confluence. Stop defined for you. Setups have fuel. I think easier to identify in real time is a really valid one here. Because a lot of these setups, you'll have these hindsight educators fucking teach it to you, and then God forbid you're able to notice it in real time. It gets really difficult. But with these, with overthrow setups, it's quite hard to miss when you get a big failed breakdown or a big failed breakout. Those are the pros. Here's another pro. There we go. Cons. So here's one. Could just be chop. I know this sucks to hear, but especially if your level selection is shitty, you could just be fooled by randomness, right? Oh, closed above, closed below, that's it, it's a failed ball, and then it just fucking isn't. That's trading, it happens. Fooled by randomness, right? Another big con, and this is something I'm still trying to kind of figure out, because most of my setups fall into the risk-defined entry, but quite simply cons, it could... you miss out, you may miss out on the basic bread and butter trade. That may not be terribly intuitive, but if you're constantly waiting for, oh, I'm going to wait for the breakdown, and then the bearish retest is going to fail, and then I'll buy the dip, or like, oh, I'm going to wait for the deviation, and then it'll spike above, and then close above, and then close below. Sometimes price just hits support and then fucking flies, right? Other times, it just hits resistance and fucking dies. And if you're sat there waiting for like a trap, or like a real overextension, deviation, whatever, a lot of the time it just doesn't fucking happen, right? It just doesn't happen, and the easy trade ends up being the best trade, while you're sat there waiting for something really spicy and really technically clean, and whereas the market just isn't always going to give you that. What I will say is quick fix, and that's obviously hyperbole, there is no quick fix, but even on bread and butter setups, there is very often a low time frame deviation, failed breakout, risk defined, right? That's something to be aware of. It doesn't really apply on low time frames as much as high time frames. But when you're trading like daily and weekly charts, a lot of the time those weekly wicks could be like a daily close above, close below at resistance, or close below, close above at support, and all that type of stuff. That's just something to be aware of. Yes, there is still a massive con of missing out on basic bread and butter trades because you're waiting for something spicy to happen. But a lot of the time, that kind of price pattern that we look for and the ones we talked about on those charts, it does happen just on lower time frames. So that's not a fix per se, but maybe an additional nuance. Right, I've got 5 more to talk about, but I feel like the stream's gone on for too long. Hopefully some of that was helpful. I'd love to get your feedback on all of this stuff so far, and maybe we can do like a part 2 or like a full video or a full article. Just let me know if you've learned anything so far and if you've got any questions. I'd love to hear your feedback. Because again, like, this is the nitty-gritty of trading, right? Like, it's fun to draw the entry triggers and the levels and look really clever with the squiggly lines and, you know, just have a lot of fun with our friends. But really, when it comes down to it, it's the entry triggers, it's the risk management, it's the trade management, that kind of ugly, not really ugly, but really the down in the trenches side, which makes trading what it is, and that's what I try at least to gear my content towards. Because it's really easy to teach someone to be an analyst, but the trading side is kind of not so easy. Whew. Okay, that's all I've got, really. If anyone happens to care, the rough categories I've got are for entries at structure, limit, candle close, overthrow, low time frame market structure. It feels embarrassing saying this with SZ in the chat. This is like his thing. Sell the high time frame wick, low time frame FTA break, and then entries beyond structure. Where is it? I mean, this is kind of counts. Candle close, above, through level, sort of. But really the big one is continuation, consolidation, entry. So that breaks into buying, bullish consolidation, selling, bearish consolidation, using consolidation post level break as support resistance. That's kind of the what I've got in my notes as the template for the article, more or less. Obviously, when I start writing these things, it always takes a life on its own and looks completely different. But roughly, that's sort of what it looks like. If you've stuck with the stream so far, hopefully you've learned something. If you want to see an article on this, or maybe a part 2, or just something, or maybe, you know, any form of further sophistication, make sure to leave a like on the video and subscribe. I will thank Bybit first for sponsoring Technical Roundup, newsletter, YouTube channel. Their support is honestly phenomenal. It's given us so much freedom to give you guys what you want, and it's just really nice to have. So thank you to them, and that is very sincere. But before I head off, if you have any questions about anything, I'm happy to hang around for a few minutes and answer to the best of my abilities before I leave you. I know this has been the furthest thing from casual Friday, but here we are. We can always talk. And the thing is, when I talk about markets on Monday, I don't want to go too hard on Friday because the content ends up being completely repetitive. Do you tend to order on one order? Yeah. I don't cluster or break up orders or split them. For me, it's one order. What is one of the most impactful trading habits you have? Ooh, if I'm just looking at a chart and I feel like a big move is going to happen, or something is like really clear, like we're about to jump to this level, or this level is going to break, etc., I will just scribble it down, even if I don't trade it, and then kind of see how it ages. I'll sometimes do it with trades as well. Like, I'll just draw a random box, or like a box that I think is significant, like a squiggly line, like, oh, this is a long, this is a short. Even if I'm not trading it, and it's one of those like gut instinct punts, I will write it down or take a screenshot and then revisit it later once it's played out. I think it's important to track your instincts and your gut feeling and see which direction it leads you and what kind of setups and when it kind of flips on, I should say. I suppose that's one of the more recent impactful trading habits. I could say like, oh, don't FOMO, I sit on my hands, all that type of stuff, but that's not what I'm, it's kind of in the past. Do you modify risk based on the type of setup and probability? Yeah, now I do. That's one of the bigger developments in my trading as well, kind of over the last 4 to 6 months. I used to be a very linear when I exercised less discretion, kind of 2%, maybe 3% per trade, no matter what. But now with more discretion, my system and my understanding of the market just tells me that some levels matter more than others. Some closes and some contexts are just have way more significant ramifications and far-reaching consequences than others. And when I'm at one of those kind of do or die, really important for the market as a whole levels, I will bet big. If I'm just playing a bounce from A to B and it's kind of meaningless in the large scheme of things, unless it's super clear, I'll usually bet less. So two things that adjust my bet size. The first one is the macro kind of context. Where are we / how much does this level really matter? And the second one is really kind of the clarity of the setup and how it fits into the big picture. So if I get something crazy, risk defined, and it's in line with the trend, and I think there's a high time frame magnet above market it's really going to go for, and everything kind of really comes together, and the risk is defined, so it allows me in a way to bet more and really know where I'm wrong and not stay in position, I'll normally bet higher on those type of scenarios as well. Hope that kind of makes sense. Well, if you made it this far, I thank you for your audience. As always, I know this may have been a bit dull for the usual pure market chatter things, but we are a trading-oriented channel. So I try my best to, from time to time, really bring in the gritty, actual trading stuff. If you enjoy it, I'll do more. Monday will be a bit more cool, just more market stuff, but there's always a time and a place for this sort of stuff as well. If you have any questions, just DM me, subscribe, leave a comment, all that stuff. I'll answer comments as well if you have any. And thank you again to Bybit for sponsoring Technical Roundup and for supporting us. That's all from me. Have a safe weekend. Благодарю вас from TraderSZ. Cheers, mate. And I will see you all on Monday. Take care.